Welcome to the deep dive. Here, we take the sources you send us, dig into them, and pull out the key knowledge, the aim, to get you well informed without you having to wade through everything yourself.
Right, doing the legwork for you.
Exactly. So, today, we're stepping into what, well, might feel like pretty separate areas. Financial markets, specifically this thing called risk premiums, and the labor market.
Yeah, not always talked about in the same breath.
Not at all. We've been working through an academic paper. Its title is Do Time-Varying Risk Premiums Explain Labor Market Performance?
Quite a title.
It is. And our mission really is to see how these two seemingly unconnected fields are actually surprisingly linked. We want to understand how changes in what investors expect to earn, above that risk-free rate.
Those risk premiums.
Those risk premiums, yeah. How they can maybe predict changes in things like employment, hiring, even what the stock market might do next.
It's fascinating stuff, especially given how separate labor economics and finance have often been treated.
Totally. It's about spotting those unexpected connections. Okay, so let's try and unpack this a bit. First off, what exactly are these time-varying risk premiums you mentioned?
Yeah, exactly. So modern finance research, it's pretty clear now that the extra return, the investors expect on top for holding stocks versus something really safe like a T-bill.
Right, the risk part.
The risk part, yeah.
Yeah.
It's not fixed. It actually moves around, it fluctuates, and this is key. You can actually predict these changes, well, to some extent anyway.
Okay, predictable fluctuations. What kind of factors signal these changes?
Well, the paper highlights a few. Think about the dividend yield. That's the stock's annual dividend payout relative to its price.
Okay.
A high dividend yield might, suggest investors see more risk ahead, demanding a higher potential return.
Mm-hmm.
Then there's the relative treasury bill rate, comparing short-term and long-term government bond yields, and also the term premium, basically the extra yield you get for tying up money in longer-term bonds because, well, more can happen over a longer time.
Right, more uncertainty.
Exactly. And the default premium, that's the yield difference between corporate bonds and safer government bonds. It's a gauge of how worried the market is about companies defaulting.
Okay, makes sense. And there was one more, CAY.
Ah, yes, CAY, the log consumption to wealth ratio. It's a bit more academic, but basically think of it as a measure of how people feel about their wealth compared to their spending.
So if people are spending a lot relative to their perceived wealth.
If CAY is high, yeah, it often means people are feeling maybe a bit stretched or cautious. This tends to correlate with higher perceived market risk and therefore higher expected returns, higher risk premiums going forward.
So all these different indicators, they're like gauges for investor sentiment and risk appetite.
Pretty much, they act as proxies for the overall discount rate that firms might implicitly use when making investment decisions, including hiring.
And the paper's big argument here is that it's not just about general interest rates changing a company's cost of capital.
Precisely. They're saying a significant chunk of the variation in that cost, especially relevant for labor decisions, comes from these shifts in the risk premium part.
Okay, that's a key point. So how does this connect directly to, say, hiring decisions?
Right. So to bridge that gap, we need to think about frictions in the labor market. The paper brings up this concept called time to build.
Time to build, like for factories, but for people.
Huh. Sort of. Yeah, in this context, it means when you hire someone, they aren't instantly 100% productive.
Sure, there's training, getting up to speed.
Exactly. Learning curve, integrating into the team. So the full benefit, the fully productive employee, that takes time to materialize.
Okay, so how does that interact with risk premiums?
Well, think about it. If risk premiums go up, that means the discount rate firms use to value future earnings also goes up. Future profits from that new hire are worth less today. Okay. So the prediction is higher risk premiums should make firms initially more hesitant to hire because the upfront costs are immediate, but the payoff is discounted more heavily. This would likely lead to lower employment growth in the short run.
But only in the short run.
Well, the model suggests that eventually firms still need workers. So as needs accumulate or conditions stabilize, they might actually increase hiring later on to catch up.
Yeah.
So maybe higher growth further down the line.
Interesting. A short-term dip potentially followed by a longer-term rise. What was the other friction mentioned? Time to plan.
Yes, time to plan. This is about the lag between the decision to hire and actually, spending the money. Think recruitment, interviews, setting up payroll, all that. It takes time and resources before the person even starts.
Right, the whole process.
Exactly. So if you combine time to plan with time to build, the theory gets a bit more nuanced. Higher risk premiums would then be expected to forecast lower net hiring rates. That's hires minus separations in the short term because of that planning lag. And also lower overall employment growth initially.
And again, potentially a rebound later.
Potentially, yes, as those planned hires eventually happen and then the build phase kicks in.
Okay, so we've got these interesting theoretical predictions based on how firms might react to risk premiums given these hiring frictions. What did the actual economic data show? Let's start with aggregate employment.
Okay, so the study looked at the growth rate of total non-farm payrolls. That's the big employment number from the Bureau of Labor Statistics.
One we hear about every month.
That's the one. And a really key finding involved that CA measure we talked about, the consumption to wealth ratio.
What did they find with CAY?
They found that high values of CAY, remember, signaling potential caution or higher perceived risk, predicted lower payroll growth in the near term, so within about, say, 6 months or 2 quarters.
Okay, so higher risk perception, slower job growth soon after.
But, and this is crucial, those same high CAY values predicted higher payroll growth further out in the longer term.
Huh. That maps pretty neatly onto that time to build idea, doesn't it?
Yeah,
Short-term caution, longer-term adjustment.
it really does seem to fit that narrative quite well.
What about when they used a wider range of those risk premium indicators, not just CAY?
Yeah, they combined several standard proxies, things like the dividend yield, term spread, default spread.
Yeah.
Looking at them together, the pattern was broadly similar. The correlation with payroll growth was negative in the short run, again, up to about 2 quarters.
Negative correlation, so high premiums, low growth.
Right. But then the correlation turned positive around the 4th quarter, so about a year out, and became significantly positive from the 8th quarter, 2 years onwards.
So the overall picture for total employment seems consistent.
Yes, the aggregate evidence points towards either a kind of 2-period time to build, meaning it takes about 2 quarters, maybe 6 months, for hiring to really translate into measured employment growth, or maybe a mix, like a 1-period time to plan plus a 1-period time to build.
Okay, that covers the overall job numbers, but hiring itself, the actual flow of people into jobs is slightly different, right? What did they find when they looked specifically at hiring rates?
Right, this is where it gets even more interesting. They looked at the net hiring rate, so gross hires minus separations, using data from places like the Current Population Survey and the JOLT survey, which tracks job openings and labor turnover.
And what was the connection with risk premiums there?
Here's the twist. Using CAY again, high CAY values actually predicted higher net hiring rates, not lower, higher. And that held across various time horizons.
Wait, higher. That seems opposite to the short-term payroll growth finding.
It does, doesn't it? And when they looked at the combined effect of all the risk premium proxies on the net hiring rate, the correlations were pretty much consistently positive.
So higher risk premiums correlated with more hiring activity, not less. How do we square that with the payroll finding?
Well, this is a really important distinction the paper makes. This finding for net hiring suggests that maybe there isn't much evidence for that time-to-plan friction in the aggregate hiring data.
Meaning firms react pretty quickly on the hiring front?
It seems that way, at least in aggregate. The decision to adjust hiring levels might happen relatively fast in response to changing risk premiums. The pattern we saw in the overall payroll growth figures, that initial dip, is then more likely driven primarily by the time-to-build mechanism.
Ah, okay. So firms might start hiring sooner, but it takes time for those hires to fully ramp up and significantly impact the total employment count.
That looks like the most plausible story based on this aggregate evidence. The hiring decision itself responds positively, perhaps surprisingly, but the impact on the stock of employed people is lagged.
That's a neat distinction. Now, you mentioned they also drilled down into the manufacturing sector specifically. Did things look different there?
They did, yes. They used different data for manufacturing, focusing on job creation and destruction metrics from researchers Davis, Faberman, and Haltiwanger. And here, some specific indicators behave differently.
Like what?
Well, the relative Treasury bill rate, for instance. In manufacturing, it showed a positive link with net job creation in the very short term, but then that relationship actually turned negative in the medium term. A different dynamic than in the aggregate picture.
Interesting. And what about the combined risk premiums in manufacturing? Did they show that positive correlation with hiring we saw in the aggregate?
No, actually. In manufacturing, when they combined the risk premium proxies, the correlation with net job creation was negative the very short term, just 1 quarter. Then it was near zero around 2 quarters out and only turned positive in the longer term, like 4 and 8 quarters.
Okay, so that looks more like the time to plan story.
Exactly. This pattern, especially the initial negative correlation, strongly suggests that within manufacturing, there is a noticeable time-to-plan lag, perhaps around 2 quarters long.
Why might manufacturing be different?
Well, you could speculate. Maybe it's due to longer production cycles, more complex supply chains, or perhaps more specialized skills needed, making the planning and recruitment phase inherently longer in manufacturing compared to, say, some service sectors.
That makes intuitive sense. It's really quite striking how these broad economic forces can play out differently across sectors. Okay, so we've spent a lot of time on how finance influences labor, but the paper flips it around too, right? Does the labor market tell us anything about future stock returns?
Yes, and this is another really compelling part of the study. They hypothesize that if employment growth is persistent, meaning good growth now suggests good growth is likely to continue for a bit.
Which it often is, right? Trends tend to continue for a while.
Generally, yes.
Yeah.
So if that holds, then past employment growth might actually predict lower future stock market excess returns.
Lower returns. Why lower?
The thinking is linked to risk premiums being countercyclical. Strong employment growth usually happens during economic expansions. During expansions, risk aversion tends to fall, uncertainty reduces, and therefore the expected future risk premium investors' demand also falls. Lower future risk premiums imply lower expected future returns.
Ah, okay. So strong job growth today might signal the economy is doing well, which means investors might expect slightly less compensation for risk going forward.
That's the logic. Good times now might mean slightly less exciting returns on the horizon because the risk component is lower.
And did the data back this up?
It did. They found that lagged payroll growth, so employment growth from previous quarters, did indeed predict lower market excess returns. This relationship was particularly noticeable over typical business cycle frequencies, say around 4 quarters or 1 year.
Wow. So payroll numbers can actually have some predictive power for the stock market. How strong was it compared to standard financial predictors?
Interestingly, they found its predictive power was often stronger than some commonly used risk premium proxies, like the default spread between corporate and government bonds, or that relative T-bill rate.
Stronger, really?
Often, yes. Although it wasn't typically as strong as that CAY measure, which consistently shows powerful predictive ability in finance literature. But still, payroll growth held its own, sometimes better than traditional financial indicators.
What about the other labor market measures? Did manufacturing job creation predict stock returns?
Yes, the net job creation rate in manufacturing also showed predictive power, again forecasting lower future stock returns, especially within the following year.
Okay, so manufacturing jobs data is also a signal. What about that aggregate net hiring rate, the one that responded positively to risk premiums?
That one. It showed weak or pretty much no ability to predict future stock market returns.
Interesting. So the overall level of employment growth in manufacturing creation seemed to contain the signal for future returns, more so than the immediate aggregate hiring flow.
That seems to be the case, yes. It aligns with the idea that the state of the labor market, reflected in payroll levels and growth, carries information about the economic cycle and expected risk premiums, perhaps more than the immediate month-to-month hiring churn in aggregate.
And this whole finding reinforces that idea of risk premiums moving opposite to the economy.
Absolutely. Risk premiums are generally countercyclical, high in bad times, low in good times. Employment growth is clearly procyclical, high in good times, low in bad times. So finding that high past employment growth predicts lower future returns fits that countercyclical risk premium story perfectly.
This really does weave finance and labor together. What does all this mean for how economists usually model these things?
Well, it has some pretty big implications. The paper points out quite directly that a lot of standard models in labor economics just assume discount rates are constant.
Which clearly isn't what the data suggests based on this research.
Not at all. These findings show that time-varying risk premiums coming from the financial side are really quite important for labor market dynamics. Ignoring them means missing a big part of the picture.
What about those more complex models, the general equilibrium ones with search and matching frictions? Do they capture this?
Some do include frictions, but the paper suggests even those can have limitations. Often, the way they're set up, the underlying assumptions might lead to risk premiums that, well, don't actually vary much over time within the model, so they might still fail to capture these empirically observed links.
So even the sophisticated models might be missing this key interaction.
It seems likely, yes. The core message here is that we really need better integration. Labor economics and asset pricing or finance need to talk to each other more in the models we build.
A call for more unified economic thinking.
Definitely. To get a fuller, more accurate understanding of how the macroeconomy works, you can't really keep these areas in separate boxes.
Okay, this has been a really fascinating dive. Let's try and boil it down. What are the absolute key takeaways for someone listening?
I'd say firstly, don't underestimate the influence of financial markets on the real economy of jobs. Those shifts in expected investment returns, the risk premiums, they have a real predictable effects on hiring and employment. It's not just abstract finance stuff.
And we saw evidence for delays, right? Time to build seems important overall.
Yes, that lag between hiring and seeing the impact on total employment seems quite robust. And then specifically in manufacturing, we saw signs of that additional time to plan lag.
And the second big takeaway, the connection runs both ways.
Absolutely. It's not just finance affecting labor. What's happening in the labor market, particularly with overall payroll growth and manufacturing job trends, can actually give us clues about where stock market returns might be headed next.
That reciprocal relationship is key.
It really underscores how interconnected things are.
So for you listening, maybe think about this. How could these insights be relevant?
Well, if you're in business, maybe understanding these links helps inform when you might want to ramp up or pull back on hiring, looking beyond just your immediate business conditions to wider market signals.
And for forecasting or policy?
It definitely suggests that analysts and policymakers could get a richer picture by looking at risk premium indicators and labor market data together, not in isolation. It might help anticipate economic turning points.
Could it even offer, say, an edge in understanding economic cycles generally?
Potentially, yes. Recognizing that risk sentiment in markets and hiring decisions on Main Street are part of the same feedback loop gives you a more dynamic view of the economy.
It really drives home that these aren't separate worlds. Finance and labor, they're deeply tangled up.
They really are.
Paying attention to those threads connecting them, well, it seems like it can unlock some genuinely valuable insights into how our economy actually works. Thanks for diving deep with us today.